first thing is it's a 1% down payment from you, but you can put as much as 2.99% down. So if you said, you know what, John, I want to put more down, you can, but not a lot more. Now, if you're buying a manufactured home, you can actually use this program. You must put 3% exactly of the purchase price, no more, no less. And then you get 2% a grant from the lender. So if you're putting 1% down, they're putting the other 2% down, and therefore you're putting 3% down. That's the minimum required for a conventional loan. So you have the opportunity. Now, I said earlier that for a conventional loan, you have to be a first-time home buyer to put 3% down, but that's not true on this program. Matter of fact, not only do you not need to be a first-time home buyer to put 3% down, with this program, you're putting 1% down, and you're still qualifying for this program, even with not being a first-time home buyer. Now, this program mandates a 620 credit score. So I said 620 is required, but this is a Fannie Mae loan. Fannie Mae makes the rules. They have a computer system that evaluates you. And when you have a 620 or 640 credit score, and you're only putting 3% down, yes, you're putting 3% down because it's your 1% plus the grant of 2%. Fannie Mae's system rarely is going to like you. Now, it's not going to put that anywhere in writing. In writing, it says you have to have a 620 credit score, but the computer system is tweaked all the time. It's an algorithm that looks at payment history and risk factors, and Fannie Mae has been tightening that box, tightening that equation. And so I'm finding anecdotally that you really need a 680 or better credit score in most cases in order for the AUS, or automated underwriting system, to approve you. Now, I can say everything looks good, but until I run it through Fannie Mae's system, you're not approved. And so it's critical to understand that, yes, the rules say 620, but history, experience says you probably want to be closer to around 680 or better. That is not a hard and fast number, but it's up to the computer to decide who qualifies and for what amount. Now, there's a couple of things that are challenges here. The first challenge is this program has a maximum loan amount of $350,000. So if you're buying in 3/4 of California, you're going to say, John, I can't find anything for $350,000. I understand that. So this program is not made for you. You can still do a 3% down conventional loan. You can still do down payment assistance, where you have assistance from the state of California, and you can buy a $800,000 home using down payment assistance. I helped a client a couple months ago use the California Dream for All program. They bought a $1.25 million home, and they got $240,000 from the state for down payment assistance. Now, that program has run out of money. It's going to come back. And so if you're interested in that program, or once we do a consultation and you realize, you know what, the only way I can afford to buy a home is using the Dream for All program, no problem. We'll wait until that program is launched. But realize that program ran out of money in 8 business days. It's going to run out even faster next time. So there's going to be fierce competition. I mean, fierce competition to get an offer accepted right away once that program's released. Well, fierce competition equals higher prices, because if buyers are competing fiercely to get their offer accepted, it means they're offering higher prices and you're going to pay more for the home. So if you can qualify without Dream for All, you should. But if the only way you can qualify, or the only way you can afford the payment, is using Dream for All, go for it. I'll be here to help you make it happen. It's just going to take really, really good timing. And if that's your strategy, your must-have list needs to be really, really tiny, because you can't be very picky when you might have one weekend to find a home. And if you don't get your offer accepted that weekend, there's a chance it's going to run out of money and you're not going to have the option for Dream for All for another year. And imagine how much more prices are going to go up in that year, and it's still going to go out pretty quickly. So if you want to use Dream for All, you need to talk to me now to get qualified so that we know you're ready. And then you need to be making your list of what is must have on the home, and it needs to be super small because you're not going to have a lot of opportunity to shop. All right, so $350 is the maximum loan amount. The second thing is you must earn under 80% of the area median income. So there's a tool. Matter of fact, I can show you right now. Let's see here. Let's go to the right here. Let's share that. And this is the Fannie Mae AMI lookup. And when you go to the Fannie Mae AMI lookup, you will see you can put in any address you want. And that address is going to be, so I will put in, I'll just put in a city. I'll put in Stockton, California. Oops, I got to hit OK first. Okay, so if I put in Stockton, California, and what it's going to do is it's going to show me what is the median income. And it says, hey, the area median income is 100,300. If you've ever looked this up before, these numbers are updated once a year in early June. And guess what? It is late June. So these numbers were just updated within the last 2 weeks. And so it says, hey, if the area median income is $100,000, then to be able to use this assistance program in San Joaquin County, you have to make a family income of less than $80,240. Now, you'd say, well, John, I make more money, but I want to buy in a more expensive neighborhood. I want to buy in San Francisco. And so what's the income limit in San Francisco? Well, the good news is San Francisco, you can make up to $126,000 and you can qualify. The problem is there's no houses under $350,000 in San Francisco. So it's not a viable option in high cost areas. But let's pretend that you're buying in Pioneer. So Pioneer is a city up in the foothills of California. And if you're buying a house in Pioneer, it says, hey, you can make $80,960. And this is based on where you're buying. So if you live in San Francisco and you're going to buy in Valley Springs. So Valley Springs is a city about 30 minutes east of Stockton up the hill. In Valley Springs, you can make $77,000 a year and use this program. And you can probably find up in the foothills something for under $350,000. There's not a lot, but they exist. And so if you're willing to move, maybe you move from a higher price area to a lower priced area. As long as you meet the income threshold of the area you're moving to, then you're fine. So this is a great option. You just have to make under 80% of the area median income. Those are the only two negatives. Maximum loan amount of $350,000. You must earn 80% or less of the area median income. But here's the best part. You have no monthly mortgage insurance payment, no mortgage insurance at all. This program, the program is offering the 2% grant and it's paying for your mortgage insurance. So you make no mortgage insurance payment at all. Like seriously, you're never paying mortgage insurance and you're literally putting 1% down. That saves you between, you're probably looking at between $250 and $400 a month that's going to save you compared to buying a $350,000 home, putting 3% down, and the mortgage insurance you would have to pay, depending upon your credit score and your debt to income ratio, that mortgage insurance is $150 to $400 a month. So it is a significant amount of savings on this program because you're not paying any mortgage insurance. All right, so I got my first question. Thankfully, the people who are watching on Zoom, I know now that you're alive, so I appreciate you guys posting that question. So Jose asks me, how do they base the income? On current pay rate or last year's tax returns? So it's a little bit of both. It's a little bit of magic. What's happening is we're looking at what we call qualifying income. Qualifying income is the income I'm using to qualify you for the mortgage. Now, I don't look at what you made last year and say, okay, well, that's what you're going to make again. Because maybe last year you got a bonus, a hiring bonus, a one-time bonus, and that's not going to continue. Maybe last year you made a bunch of overtime, but your overtime is decreasing now and you're not making as much. Or your employer says, we're not going to be working as much overtime anymore. And so we don't count the overtime. Maybe you got a pay raise. So maybe last year you started halfway through the year, and here we are, you just hit your 1 year anniversary and your pay went up significantly. I will count your pay based on the pay raise. Now, there's some ways I can get creative. Maybe you got a pay raise, but you qualified even before the pay raise. I don't have to tell them you got the pay raise. So there's some ways in which I can help you, but you have to qualify for the mortgage with the same income that we're looking at for saying, are you under the 80% number? And so it's really my evaluation of how I'm calculating your income. And there is no one simple answer, Jose. It's not just your current pay rate. It's not just last year. It's essentially what the mortgage industry looks at. And I'll talk about in a couple of minutes, but this will give us a head start on it. And so when we're looking at your pay, we're trying to predict the future based on what's happened over the last 2 years and what we expect to happen over the next 3. And so there's a lot of variables that come into that. And I'm an expert on how to navigate those numbers. And there's times when I can look at it a little bit different than maybe we want to be less aggressive in order for you to be under that 80% number. And there's ways we can make that work. So hopefully that helps answer your question, Jose. Anybody else, especially on Zoom, let me know if you have questions. Feel free to post into chat. It just reminds me that you're here and you're listening and I haven't put you to sleep. All right. So let's look at the numbers for the 1% down program. Now, remember, I told you earlier, you've got down payment and then you have closing costs. So let's talk about what this looks like in numbers. So if you did the 1% down with you paying the normal closing costs, so you're going to get a rate in the high 6s, you're paying 1 point or 1% of your loan amount for that interest rate. Your payment's about $2,700 a month, and you're coming in with about $17,000 out of pocket for your 1% down plus your closing costs. And you say, whoa, John, hold on a minute. You said 1% down and buying a $350,000 home. 1% is $3,500. There's always a trick, and you tricked me, John, because you're telling me 1% down, and now you want an extra, $12,000, $13,000 on top of that. Well, because of the closing costs, but there's other options. So let's look at door number 2. We can bump the interest rate a little bit. This is where I said you could get a lender credit. You can decrease your closing costs by increasing your interest rate. So you save 1% off of your fees. So it's $3,400 less expensive in upfront costs. Now, it still doesn't get you close to the numbers you're looking for. I'll show you how to do that in a second. But what you're trading off is you're trading off a payment of $145 a month more. So you have to decide, can I come up with the money myself, or should I pay the extra $145 a month? It's a trade-off. The final piece, this is really door number 3. This is the option that allows you to buy with 1% down and really only have 1%. And that's by getting a seller credit. So if we use this less fee option, so we got a little bit higher of an interest rate, so your payment's $2,840, but you get a 3% credit from the seller. That 3% seller credit is about $10,000. So now, instead of paying $13,000, you're only paying $3,000. So $3,500. So that's how you truly buy a $350,000 home with only 1% out of pocket. You've got to have the seller willing to give you a seller credit of 3%, or in this case, approximately $10,000, and you truly can buy a home with $3,500 out of pocket. It is an absolutely amazing program.